Okay, so now let's try to understand about current year taxes and the future year taxes through a real world example. So let's take the fact that Apple company sells $1 million of gift cards in year one. Let's suppose they entered into a new business wherein they are going to sell $1 million of gift cards and the corporate tax is 21%. Now what will happen? Revenue is recognized only when the gift cards are redeemed, because as per the revenue rules or as per the gap rules, what happens, like you sell the gift card but people have not redeemed those gift cards till the time, you cannot recognize the revenue in your books. Why? Because those gift cards are still not being used by the customer, so the revenue cannot be recognized. So in that case, the books, as per the gap or generally accepted accounting principles, they books will say there is a zero revenue in our books, and book income for the gift card, it will again be zero, and the taxes again it will be zero. Why? Because there is no revenue, so we cannot charge the expenses as well. Now in second, not second, as per the tax rule, what will happen? Tax rule simply says that when cash is received, the taxes should be charged. So what will happen in the year one, when Apple company has sold those gift cards but people have not redeemed them, despite people not redeeming, income tax will be saying that your taxable income is $1 million. Why they will say it? Because income tax, it doesn't count for this timing difference or accrual accounting concepts. The income tax simply knows, okay, business got the cash, now they need to pay the taxes. So there will be the tax paid of 21% on this 1 million, which will arise 210 grands for taxes to be paid. Now the thought will be like, why inter-period tax allocation is needed? Because you know that taxes are paid now and revenue recognition will happen later. So this is a timing difference between book income and taxable income, and due to those timing difference only, we need to identify the taxes paid as per IRS and taxes as per books of income. Okay, now if someone asks you that what are your current year taxes, okay, then you will say Apple will be paying $210,000 to IRS in year one. Why? Because as per IRS rule, the taxes are applicable, but as per books, there was no taxes. So you will say this is your income tax payable, your income tax liability, because you need to pay to the IRS. Now what will happen, like in future year, when year 2, 3, 4 somehow will come and people will redeem those gift cards, then what will happen? You know that Apple has already paid taxes before, and what will happen, and recognize the revenue as per IRS. So as per IRS they have done that. Now when revenue is recognized as per your books of accounts or as per gap, now will the company pay taxes again? You will say no, company won't pay taxes again, there won't be any need to pay taxes again. So in future the company will get the benefit of $210,000, you know that, right? Because income tax cannot come again and say pay taxes again on the same income. So you will say, because the company will get the benefit of these taxes which have been paid, I can say today, uh, their benefit will be received in future. So due to that benefit to be received in future, we call that as deferred tax assets, or we call as this as a DTA, because we will get the benefit of these in future. So this is simple, we call that as a DTA. Now let's see the summary table against this, wherein it simply says that current year taxes you have paid now $210,000, then you will have an income tax liability. To income tax you will be paying 210,000, but at the same time in future you will be getting a benefit of 210,000. So you will say this is my deferred tax assets. And how you will create the accounting entry for that? So you will say deferred tax asset is my asset, so this will be for $210,000, and this income tax payable liability is my liability. So you will say income tax payable, and this will be your liability for $210,000. So this will become your accounting entry for this. Now let's see the same thing through our textbook concept, that how the current year taxes versus the future year taxes looks like. So you know that recognizing the revenue will be based upon matching concept in our gap, which is when you recognize the revenue, there will be expenses. Now there are current year taxes, there are future year taxes. Okay, so if there is a current year tax, which is like in current year you have paid your taxes, in our example we have paid our $210,000 to income tax, then that has created a asset for us. Okay, and if you so based upon our example only, I'm just giving you this thing. Otherwise if I talk about this and this in a detail, it may be a little bit confusing, but overall the theme is simple. In the current year, if you had paid taxes and the benefit you are going to receive in future, you will call that as a deferred tax assets, because you paid taxes today and you are going to get the benefits later on. Now in deferred tax liability, what may happen? You get the benefit today. So you get the benefit today, meaning you haven't paid tax today, no tax today. Then in future you will have to pay taxes. So that will create your deferred tax liability. So we will go through all of these things in detail, but this is about the introductory thing about current year taxes and future year taxes.